At today's interest rate environment, it's just not possible for the model to work in Jacksonville and in many parts of the country when it comes to 6.5% interest rates and positive cash flow. It's just not there.
So now you just like raise my anxiety as somebody that is trying to like build a portfolio to retire on. We've got these headlines. You can see it all over the place. Bank of America, Deutsche Bank specifically. Bank of America is predicting three interest rate hikes coming up with this new Fed chairman coming in. Big change from kind of like how we started this year. This has been an ongoing conversation inside of the Not Your Average Investor Show community. When you're hearing these headlines, what are you thinking about?
Just thinking how much the world can change and interest rate expectations. Towards the end of the year, when we were putting our predictions together for this year, we were pretty confident that rates were going to come down. Maybe not a lot, but the idea that we would be sitting here talking about three potential rate hikes from the Fed, from a trusted institution like Bank of America, was just off the table. And now I don't know if it's going to be three. I don't know if it's going to be one. I don't know if it's going to go up or down or whatnot, because nobody knows. And I think that's the real theme. From week to week to week, it changes so much. But the backdrop now is that we are all bracing for rate increases. And I think that's noteworthy. The way that it affects everybody in the economy is that means borrowing costs on almost everything go up. And as we think about it from an investor lens, that absolutely correlates to investments not producing as much cash flow because the borrowing costs for every investment or every company goes up. That means it's that much harder for them to produce a net income on a monthly basis and a return on investment from that cash flow. So not great news that we're all bracing for the worst here, but the silver lining is tune in next week because it might be different.
Yeah. Silver lining is we are not off the roller coaster, right? Can you kind of like talk me through how that affects the different kind of like real estate ways that you invest in single family homes, right? From what I understand as a rental property investor, I've bought a home. I have a 30-year mortgage on it. How does that affect me as a rental property owner right now?
If you're like Pablo and you already own assets with JWB, or you're probably like most rental property owners who have mortgages that are fixed, this news doesn't affect your monthly cash flow. That's one of the best things about rental properties. Your returns go up, your rental incomes goes up, and home price appreciation, all that goes up, but your biggest expense, which is your mortgage payment, stays flat and it's fixed. That doesn't affect your monthly cash flow. However, we're all affected by what interest rates are doing. And so if Pablo is looking at his biggest profit center, which is not net rental income, but is looking at home price appreciation, one thing we know is that when you see higher elevated interest rates, it suppresses demand. What's happened there is that it's not like people don't want to buy houses, especially in Jacksonville, but people are on the sidelines and they're saying, well, I'm going to wait for this interest rate to come down. And so it suppresses demand. So directly, you're not affected because you have fixed rate mortgages. Indirectly, it affects home price appreciation. The longer that interest rates stay elevated, and if they continue to go higher, we would expect more suppression of demand, which will be released on the other side as interest rates do come down.
You mentioned delaying home price appreciation. You mentioned suppressing demand. Do you see this as still kind of like in the narrative of like it's only going to make it, it's going to increase demand, increase home price appreciation when it comes back around kind of thing? Are we still there or are we beyond that these days?
I do. I think the longer interest rates stay higher, the greater the rebound effect will be on the other side of them. However, this is the only time in recorded history that interest rates have gone up this fast, stayed this high for this long. So really interesting. I was just looking at the market data for June. Would you know that even though we've got all this craziness going on in the world, and even though interest rates are higher than we all want, they've been that way for forever, would you know that we had 4.9% home price appreciation year over year in Jacksonville in June? We set the single highest price in the history of Jacksonville real estate in June of this year. So interesting. What may also be happening is that, people can only sit on the sidelines and not buy for so long before life happens. And it's just better for them to be able to buy and not sit on the sidelines. Side note, it's always better to buy and then just refinance later, even if you think interest rates are too high. But not everybody understands that. So this might just be a little bit of maybe this is just becoming a new normal for people. We're looking at data really from the last 3 months, 6 months. So I'm not jumping to that conclusion yet. But what I am seeing and what we're seeing a lot over the last few months is that sales are picking up. Home price appreciation is noticeably higher than it was a year ago, even though interest rates are higher.
Yeah. Interesting, man. Let's talk about now about anybody that's thinking about expanding their portfolio or getting into rental properties right now. Is this a bad time to buy now because we've been at high, it's going to continue to go high? Or are you seeing the idea that like, maybe we've met this part where like the market's over kind of like the anchoring to the past and they're just making better decisions. So we're going to go back into like a more normal kind of like scenario.
Well, everybody on the show knows me long enough now. I've been doing this for 6 years. There has never been a time I've said it's been a bad time to buy because I know how this thing goes. Buying these assets, holding on to them, and then seeing how they can change your life over a 10-year period or longer is life changing. And so it is a good time to buy, but it's a whole lot harder today than it was even 6 months ago when we had a little bit of interest rate relief, or certainly a few years ago. The challenge is that your cash flows are much, much harder to come by. And people, at least our clientele, doesn't like to get into an investment that they are going to have to pay money towards on a regular basis. In today's current interest rate environment, as interest rates are higher, that might mean that positive cash flow rental property that you may have considered may have gone from positive to negative cash flow in the first year. It might be negative cash flow for your first 2 years or even longer because interest rates are no longer 4% and now they're 6.5%. The idea, if you are an rental property investor and you love this asset simply because of net rental income, number one, you're missing the point. And number two, you're not going to be happy. This is making it much harder for the numbers to pencil, specifically looking because of cash flow.
So it makes it a decision now where people are walking in thinking, I'm going to go in negative cash flow to bet for appreciation and then get cash flow later in Jacksonville.
Usually they don't make that decision. Usually negative cash flow is a deal killer in the
Yeah.
minds of a passive income rental property investor. If they're focused on the Jacksonville market and they're buying at today's current interest rate environment, which is like 6.5% interest rates, they usually go down two paths. What they'll do is they can put a lot more money down. You can put 30% down or 35% or 40% down. And then even at 6.5% interest rates, you're still going to be cash flow positive. So many people will go down that route. If they don't have the ability to have that capital to put that down, that increased capital, then sometimes what they do is they go down the route of going into neighborhoods that are lower income, that have lower purchase prices, that on paper look like they produce positive cash flow, but through experience, the maintenance costs, the vacancy costs, the property turn cost, all those expenses eat up whatever positive cash flow you put on that fancy little spreadsheet. The other alternative is sometimes they just take more of an active route. And so sometimes people say, you know what, I want to go and find my own property, and that way I can get a little bit of a better deal. And so then they end up spending a lot more of their time, whether or not they're more successful doing it that way. Each investor is a little bit different, but at today's interest rate environment, it's just not possible for the model to work in Jacksonville and in many parts of the country when it comes to 6.5% interest rates and positive cash flow. It's just not there. It's just that's what the higher interest rates do.
Okay. So now you just like raise my anxiety as somebody that is trying to like build a portfolio to retire on. And I'm, like, me, I'm kind of like on this part of my career where I have time to grow my portfolio. I'm looking for things to invest in. So is the answer to then go look for a cash flow positive market if I like the Jacksonville thing? Like what are we doing here, man?
Do you think I like scared people with how flippantly I just said that?
Yeah, yeah. That's like the most negative I've ever heard you, man. Yeah.
I'm just being real. I mean, the big caveat there is I keep saying at today's current interest rate environment. So obviously, all of our JWB clients, you guys don't have to worry. We're miles and miles ahead of this. We've been thinking about this for forever, and you guys have seen us consistently look at your investment opportunity. And I've been up here for 5 or 6 years, and I've always said, hey, listen, this is a good time to buy with JWB. And so you don't have anything to worry about. This is a great time to buy when you have a partner who thinks about your return on investment and your positive cash flow as the end result here, and they work backwards and they put a pro forma together and they negotiate with their lending teammates and their insurance teammates and the costs that go in and negotiate on your behalf to be able to come up with solutions so that they can produce cash flow positive investments at the end of the day that are going to be able to serve your retirement or serve whatever financial outcome is. And you guys know that's the way that we operate. We've been operating that way for 20 years. So sorry to scare all of you if I just said it so flippantly and just left that cliffhanger out there. Pablo and I, of course, are going to walk you through how this works for you. So for JWB, like we can't just be subject to the whims of the market, right? If we're going to be here to produce a financial outcome for you, and we're going to help you get onto a buying plan where you can buy one or two or three or five properties a year, we can't just have an answer for you in a year when you say, hey, I want to buy five assets and say, oh, well, you know what? Interest rates are too high. Scrap that plan. No, we're here to serve you for 5 years, 10 years, 20 years. So for us, we always work with the end in mind and then we work backwards. And so that's what we've done. We've been working with our partners, our lender partners for sure. We're excited to talk about what we've been able to secure on behalf of our clients. Pablo, a couple of weeks ago, I think you shared the 3.99% interest rate, which is, I'm going to say that again. It's a 3.99% interest rate. It's fixed for 7 years for you and for your rental properties. That's what we've been able to do, along with continuing to waive the first year tenant placement fee. At the end of the day, what this does is it sets you up for positive cash flow, sets you up to continue your buying plan, whether it's your first investment or this is your 10th. You can continue to operate in this beautiful little bubble that we have where you're still cash flow positive. You still have an above average return on investment, and you're with a partner who's produced for you for 20 years and can protect that client experience. So there's the full answer there, Pobs, not just the
Thank you.
cliffhanger.
As somebody that's in this like active cycle of like still building my like
Hmm.
I'm in my acquisition phase still, it allows me to think, okay, cool. If whatever mortgage rates are going to be doing over the next like year or two or whatever, like I can now secure this thing on my own schedule, continue to build this thing, not have to be in negative cash flow positions in the individual asset because this rate allows for that. And I'm just kind of like sitting pretty waiting for like everything else to normalize around it as this goes on.
The feeling that I always want our clients to have is that when you are ready to make that next purchase, it is the same core investment with the same principles, with the same five profit centers, and it's like you have the answers to the test. You're investing in a model. The property more or less is just a widget. You're investing in a model. And so we always want to kind of standardize, right? To replicate this thing, this beautiful investment model that we have with single family rental properties. And so no matter what gets thrown at us, interest rates or more home price appreciation, less home price appreciation, we just want to be that constant in your investment portfolio. And so that's what you're going to see, even as interest rates have spiked higher than we want. And the war in Iran is, unfortunately, it's not closed, it's not over, right? None of that really matters. You're insulated from it when it comes to a JWB rental property investment.
Got it.